Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for the week ending on May 12th. My name is Ian Saunders. I'm joined this week by Steve Raymond. Steve, it's good to be in person here, sitting across from you. We're recording this a little bit earlier in the week. It's kind of midday Tuesday at the time of this recording, but we got a pretty timely topic to talk about this week. Across the board, right? I know that there's been a lot of movement over the past week in the broader kind of core equity market for the S&P, at least. Been a lot of kind of back and forth movement over the past few weeks. And we had some of the conversation last week between Miles and I we talked a little bit about the general concept of market seasonality, kind of some of the themes we've seen over the past 6 months and what we're looking at as we transition. But we also had some pretty important models on the platform that saw a seasonal shift take place, that you were more so really just took advantage of the seasonal opportunity to make changes to those models, right? Those being those fund score method models that I know you created there.
A point to preamble that would be, we've had seasonal models for some years here at Dorsey Wright, predicated on the biases that we find in the market over many decades. Even a decade at a time, is there a seasonal bias to the market? And so seasonality, I think in general was thought of as, well, May through November is different than November through May in term profiles of markets. And I'm fine with that definition. What I actually focus on is that historically, the May through November, November through May timeframes are dissimilar return profiles, meaning that there's a lot of disparity between those two periods of time. Although some people think, well, that always means that the May through November is the negative one and the November through the May is the positive one. That's not always true. What's more true is there's a big inflection difference in return profiles. Now, for that reason, we actually picked these certain time frames to adjust models. We don't tell the models what to do, but we allow them to take a look at what's going on in the market themes and make adjustments. So we use 4 seasonal quarters, 2 for each what an academic would call a seasonal time frame in the market, 2 over here, 2 over there.
So there's still there's still 4 times a year, yes, but it's just off count.
Right. And the biases, that's a bias we look at. We're a relative strength provider as well, shop as well. And momentum has cycles and certainly attributes and biases there. So really, when you look at the models we're about to talk about today, we're combining really a seasonal bias and then a momentum bias.
Do you think momentum bias is different than the broader market seasonal bias? I mean, kind of a different question, but do you think that that's a different kind of conversation that we're trying to take advantage of a little bit more here?
I think there are independent streams that inflect greatly or diminish differently from each other. So it's a good question. If you studied all the material, you might walk away saying, I think I see the seasonal bias in the long-term markets for 100 years and can find it more so than I can find momentum everywhere at all times. So I think it's a now, when we say bias, remember that a bias doesn't mean that it's you're going to triple your money every year just by following a bias. But it does inflect to compound and grow over time. But anyway, these are the reasons why we use seasonal apparatuses in our models and in that sense.
And I think you put it pretty cleanly there, that it's not necessarily kind of better or worse, it's just different, right? It's different market environments, and we've seen a pretty different market environments over the last seasonally weak period, from May of last year through October. And I mean, you were looking at this past seasonally strong period, market was up a little over 4%, and the market was up a little over 4% for the month of April alone, So, I mean, it was just a lot of kind of back and forth movement. And I mean, when we're looking into this up and coming, this shift that has taken place now, we had the models evaluated last week, if that's right. And that was all the seasonal, all the FSM models on the FSM fund score method models that we have on the platform.
Right. And so on that particular time frame, we have multiple models, the majority of which will use that seasonal date to update. They've all updated. They made it through the update alive. And here we are. We've opened up the what you call the first seasonal quarter from May through to November. Some people number it the week seasonal cycle, which is fine because often it is the week seasonal cycle. I just say historically that's not always true, but we do expect it could be different in return profile than the prior cycle. And so we have models doing some different things. As we've come into the year 2023, we've made it through February, which is a quarter, and now in May, which is the start of the quarter we're talking about now. We've had these models cycle into really some new holdings that we had not seen in total prior to this. So that could be something we talk about is, what do these models own?
Yeah. And I mean, I think maybe talking a little bit about the background of this. So when we're looking at, we have over 100 different models on the platform, right? And there's really kind of two main focuses of model frameworks. There's like the strictly relative strength chart-based models, which are matrix-based models, which take advantage of just specific relative strength relationships, right? And try to overweight towards the stronger areas in that defined universe. Whereas the FSM or the fund score method still incorporating relative strength, just in a different kind of fashion. So I don't know if you maybe just, what is a fund score? What is it when we're looking at those? And then when we're looking at stronger areas, how is that? What are we looking at when we say strength there?
Right. So a fund score is going to read not only the chart of let's say the fund we're working with. In this case, we might be talking about ETFs first. So you're reading the ETF chart, and then we look at relative strength charts with that ETF chart. But then we also look at a multitude of other return profile data points that are laddered that also inflect, and then the score will land between a 0 and 6 score and tell us where the higher the score, the stronger the momentum factor, the relative strength factor, but also including price trending, and then moving average, different things of this nature. So so it gives the fund score allows us to kind of better compare a fund to another fund,
and it's independent of what you're comparing it to, right? And the score is just the score for EFA or SPY, which no matter what you're comparing it to, it's that same score.
It has its own score. It's like its own ID card or driver's license or its own credit card. It's itself, and then that's in competition with other items in the inventory. So it's easy to use, and so that a lot of advisors appreciate the fund score because it's just it's easy to interpret.
I think that's an important thing to keep in mind. We were talking about different, like not necessarily better or worse during seasonal. Same when you're looking at relative strength matrix or score. It's not better or worse, it's different, right? It's that ease of use capability. 0 to 6, 0 is the worst, 6 is the best. That's easy for anybody to understand.
That's right, and easy to implement, because sometimes you want to take some nice inventory and put it over here and do it again, or put it over there. A little bit more cumbersome to do that on other apparatuses we have, but fund score just translates right over. You could think of it as ease of manipulation to in different inventories. But the fund scores are really pronounced and moving around this year. And if you think about the last year and a half, 2 years, we've seen some activity
for sure
in the scores. And of course, as we rolled our way into May from April, we have some new things going on.
And so when we're looking at the FSM fund score method models, right? So we're taking those fund scores. Every fund has a score from 0 to 6. 0 is the worst, 6 is the best, and then we just take different inventories essentially of funds, whether maybe a couple of different ETF inventories that we'll talk about at the front end, and then a couple different mutual fund inventories that we'll talk about. But if it's an ETF or a mutual fund, they both have scores from 0 to 6. Typically want to compare ETFs against ETFs, mutual funds against mutual funds. And then we simply sort that inventory by score, at those set evaluation points, which are on the seasonal quarter. So Yeah, I think another beauty of the FSM framework is when stuff is changing, if it's going to change, right? I mean, so it allows us to be saying is where we saw a lot of movement right up until last week with things moving in and out, and ended up with a pretty unique lineup within one of the models, looking at the all cap world model, the core solution all cap world, which is looking at holding two funds out of a broader global equity focused inventory. So there's the potential to go US or elsewhere, and we saw that happen this time, right?
We sure did. And this is kind of a landmark entry of the EFA, which is the EFA index, moving into the top alignment. Of course, that's developed non-US. That's another way to say that. It moves up into the top rank and is part of the top 2 holding. And we haven't seen activity like that, and I'd like to say 10 years.
It's
maybe
2010. 12. I think last time any international was in that model, right?
Right. So in that sense is what I meant by landmark, is that your advisor, you're using these models, many people do, or you don't know about Dorsey Wright and you're hearing about it first time. I'm just suggesting that we haven't seen a passive index international piece go into a model like this model in quite a while, and it's very encouraging, or you could say very outstanding, or you have to kind of get your head around it to say, these things are making a change. So that could be implicative of what we'll continue to see in the future, although it's hard to prognosticate how long a particular theme lasts in the market, but it could. And that was joined with more of the equal-weighted Nasdaq 100, which we could call that QQEW as the symbol, but that would be more of that equal-weighted, you could say technology growth associated type of theme, which again kind of confounds some folks that think, well, I thought growth went out of favor. I thought science and tech went out of favor, but there was a lapse, as we moved through 2021 and 22, meaning of the years, that we had some problems with some of the technology areas, but they've roared back here in this particular cycle, and so we've chosen the model's chosen. We didn't we didn't choose it. The model chose it based on fund score. Correct. So really, what you have is what I call a little bit of an odd mixture, which is high quality, more so larger cap tech theme with a non-US developed market theme. In general, that's more of a rare combination. More of a rare combination.
You remember seeing that before?
Not quite exactly like this, but the analogy might be something in the early 2000s through 2010, where you had a strong non-US theme, but then at the same time, you did not have a strong US tech theme. See, if you remember, we may have wanted to talk about this later in the podcast, but we'll just talk about it now, is that, in that decade, the 2002 through 2010 is known as the lost decade, because of the core of the market, with its growth components as well, really went low, fell off from relative strength. So this time, at least at this particular instance, we see that the core is still strong, and this growth theme, this technology theme, has been very strong, certainly here in the first half of 2023. And so that's why I meant it's a slightly different than what we've seen historically. But this is what we do. We try not to prognosticate what should happen and when it should happen, and then prognosticate what's going to happen next. We try to go with what is.
Right. And so in looking at that theme, maybe taking those two themes, right? You have the tech growth side, and then you have the kind of international side, which is, I mean, this model's all changes in both of those, holding EFA and QQEW. One interesting point that I do want to ask you about I feel like a lot of the conversation broadly across domestic equity markets, mega cap.
Right.
You saw the equal weight outscore the cap weighted from the Q's perspective.
Right.
It's it's interesting to see from fund scores that you're seeing the equal weight. I mean, they're both top 100 non-financial companies than the
Right.
Nasdaq, so big companies. But
Right.
it's kind of interesting to see the equal weight actually outpace at least from a technical scoring perspective, the cap weighted there.
It is, because you could say that in the equal weighted S&P 500 is it depends on how you measure it, but the cap weight's a little stronger than the equal weight in the S&P 500. But here the equal weight's a little bit stronger than the cap weight in the Nasdaq 100. But I just think it just means there's more of a broader appeal for all the
it speaks stronger to the broader
breadth.
Yeah.
That this is not just a one company or the top 5 companies, control the whole index type of scenario here.
Right.
It's more broader than that, which is and some people feel more comfortable with that.
Yeah.
Let's get equal weighted. As you know, Dorsey Wright has been in a sense focusing on equal weighting and focusing on using the mechanics of equal weighting longer than almost any firm on the street. We've been doing this for some decades, where possible, and so here it is. So it really is. But I think if you woke up on the first day of the year, January 1, or you went to work on January 2, whatever you did, the last thing you would expect is that the equal-weighted Qs would be up there with the the developed international markets, somewhere between February and April or May. It'd be the last thing you guess, but here we are, and that's why we go with what is. This could be the beginning or inside of the beginning of a longer trend.
Right.
And as most people know, I think they'll buy into this statement, is that we do want to catch trends. That's how we make money.
Right.
It's
momentum, trend following.
It's not the day trading. It's not the idea of day trading at all. The idea is to identify market trends and ride those trends, and hopefully those trends will continue for a long time. However, it could be that this trend doesn't.
Right.
But then again, the model's designed to identify trends to go with trends. So we think that there's a shot here of that trend continuing. So but that's the all cap world.
And that's not to say that the QQEW, QQQ still showed strength, right?
Absolutely.
We saw that reflected in, you mentioned the all cap world, and then another ETF focused model, the US core, which doesn't include the international side. So we'll single out the kind of growth tech stuff.
Right.
It also doesn't include QQEW, it just includes QQQ.
Correct.
And we saw QQQ come into the model.
Yeah,
right?
it moved right up into first place. So so again, it's this growth, whoever has the best definition of it, technology related area, theme, and that's really taking command of that US core. To give you an idea, if we zoom out and talk about the US core in general, the US core is like a kind of S&P 500-ish versions of high vol, low vol, different weighting schemes that are measured simultaneously. And the percentile rank of the US core against all asset classes around the world is near the 95th percentile. So that's a super strong reading.
And it's maintained some strength, right? This isn't something that just happened over the past few weeks.
No, it's maintained it really for, as some would say, for some years, and it's still here. I think that, again, the last time non-US assets came roaring in to command a model was like you said, roughly 2010, 2000.
Which is kind of the tail end of
the tail end of that, but maybe 2000, 2001, and 2. In that context, the percentile rank of the core market of the US was at 50 or under. 50, 40, 30, 20, very low readings. So again, here we have a high core percentile rank of the US core. Qs are leading or a leading factor in that part. And then statement number 2 is non-US has some very, very big strength as well.
And we saw, I think the others, we're talking about some of the models showing consistency too, right? I think it's interesting in some of the all cap world model, we didn't see international come in earlier this year. Other models on the site, we did.
That's
right?
right.
And that's like T Rowe, for example. Looking at the mutual
Right.
fund side, we didn't see any pivots into international at this go around. That's because it was already in
Right.
international, right?
Right.
So it's seeing that kind of consistent. We talked a lot about international equities in written research podcast. We kind of hammer in that it's a top ranked in Dolly,
Right.
higher ranked in the group scores.
Right.
There's just consistency and strength, but it's been consistent for a prolonged period of time now. It's not just the past couple months that it's shot up, right?
That's correct. And so like Rowe Price, we had several non-US pieces in there, international, excuse me.
Right.
And then we had another international piece move in there. So really it's in that case, it's evolving, blooming out more. I'll make a point though, that in active managers, because I can say Rowe Price, I could mention other, I'm sure we will, other active managers. We saw international coming earlier in the time zone.
You think it's due to the management?
I think it's due to they geared what they're able to pick the better
and the scores
underlying, and the scores reflect that, whereas the passive indices seem to be coming as a second tier. But in models like a Rowe Price model, the international theme has been blossoming in there for all this year, and it's continuing.
Which for that model, it's looking at domestic equity representatives, like their full kind of T Rowe lineup of funds. So it's like, it can go fixed income, it can go equity, it can pivot around. And it's, there's same themes we're looking at before. They're pretty consistent with some of these changes, right?
Yes. So in that sense, you have their science and tech fund actually shot up into the top 5. Which again, if you think about it, it gets back to this larger Nasdaq 100 related area, and then that joins this international, contingent. U.S. dividend growth moved in, and there's a fund that barely didn't get in, and that was called the European Stock Fund. So that gives you another developed non-US international piece, which is just amazing. But we have rules of how we run the models, and who, we only pick 5. There are rules of how to get into the 5, and it just almost got in, but at the end of the day, it didn't make it in, but it's right there. So it's right there at the number 6 position, ready to fight to maybe.
And that Europe group has been one of the strongest areas on the group score stage for a while. That's talk about consistency. It's been up there north of that 4.0 score average for a while now.
The group scores have helped us as analysts and as a firm, and the community that follows the firm to say, the non-US has been doing incredible things early on as we started this year. And quite frankly, the European fund collection is basically the number 1 score. And on our asset class group scores. And that's kind of a rare event also. So again, what we're saying is we're seeing, I think, historic, interesting times, and the models which we had built to figure this out. They went and figured it out. So
we're not picking them. We're just letting the models pick themselves. That's what they've shown.
It's rules based. Let the models pick that. Interestingly, is that like, let's say another manager or another active manager, American funds.
Right.
So American funds has had similar things that we talked about with Rowe Price, where they had international pieces moving in. You could say, blends, international blends earlier,
like in February, right?
Yeah, and that expanded this round, and so the 2 new funds that came into the top 5 are, interestingly enough, the New Economy Fund, which is that larger growth, more leading edge US piece, classically, is the number 1 score out of the top 5. It's incredible to lunge that strongly. And then New World, which, as most people may or may not know, is actually the oldest emerging markets fund available to investors on the planet.
Really?
Yeah. American funds have been around way, multitude of years before ETFs were ever, made.
They're around a little bit before.
And really New World was that first viable emerging market. Obviously that means non-US funds way back. So that actually came into this top 5 lineup, which is just astounding. We haven't seen New World in the lineup in some years.
And I think that's really interesting on the emerging market side, because we're talking a lot about Europe, and Europe developed strength.
Right.
To see, talk about breadth, right? To see other areas, and some areas of emerging markets have certainly not been too hot recently, but others have been, right? You see that reflecting some of these too.
American funds runs, and again, I'll give another nomer to this fund, New World. It's the most conservative emerging market fund on the planet. It has the lowest, what I call relative risk to other funds in that group. And what that might mean, conservative, is they don't, they're careful as to what they pick in emerging markets. Maybe not there's some active management in there to make this thing work. But certainly, that could be an answer why this emerging markets fund is better in strength than other emerging market funds, because there's a different way that they construct the portfolio. So I would say this is probably right. The emerging market fund, or a passive index emerging market fund, is probably not a super high score. But this actively managed New World emerging market fund is doing well, and I've seen that historically. I've seen it actually lead emerging market waves that came later. And I think the important thing here is this is not the dangerous edge of emerging markets, meaning the high volatility. This is not the
CEM has a different thought going on in people's head a lot of times, but this is not that.
This is a more conservative play, and quite frankly, which is comforting, because these are strenuous times psychologically for market participants. So you want to know that the funds we're talking about from American funds are built to survive, and they have a conservative angle, and so you could say relatively safer than maybe other investment choices.
Yeah.
But again, if you kind of recap the 4 models we just talked about, they all have this same thread going through them. There's a new inflection in science, technology, larger growth. It's a new inflection. And then there's a building upon international weighting schemes. In other words, we had some, now we're building on it. Now we're building on it. And so you could say that we're
you're set up well.
2/3 international, maybe,
depending upon the model,
maybe and 1/3 US. So again, I think exciting themes to keep a hold of. Of course, we know we live in this world too. We know these are strenuous times, but these themes could be themes that last for a while. I do remember in going through the 1999, 2000, 2001, 2002 paradigm, that as we got into that new millennium, that we started seeing things that we hadn't seen prior, and you could say to yourself, well, this is probably a blip on the radar, won't last, and that would be a mistake. So it did last. It did last for years. So again, the same, we do it the same way here. We go with what is, and if it keeps being the case, we keep going with it.
Yeah, and I think you said it. We're trend following, right? We're not trying to capture those weekly trends. We're looking for those longer term thematic shifts, right? And so seeing that consistency and international coming in, and then continuing with that, seeing technology coming in, and it's not just Nasdaq had a great first quarter. We're seeing that consistency kind of continue to broaden out, and I think that'll be a really interesting place to monitor as we move through this different seasonal environment. Maybe not kind of the highlighting the different nature of what we're coming up over the month of May and beyond. Will definitely be a pretty interesting place to monitor here.
It sure will. And in the next update, is in the front end of August.
Right. So there's been 2 down. We got 2 to go.
Yep. And then we'll move on to there to, further on to November. But again, now we highlight models, and many of our clients follow the very models that we highlight, although we have maybe 30 or 50 or 100. But the idea here is that these are high quality shops from an active manager's point of view, and high quality ETFs that are highly liquid, well known, and they're really the bedrock of what you would call net assets and who owns what out there, very highly regarded. So I think these models are certainly do things that are doing things that are fresh and new from some people's point of view, but we're going with it, and we think it's a great way to have be used in your business to stay on top of the trends as they unfold.
Right. Yeah, and it'll be interesting to monitor, as you said, the next. So there's 2 evaluations left, beginning of August and then the beginning of November.
Correct.
After that kind of second seasonal, the next seasonal period. But it'll be interesting to monitor how this stuff shakes out over the course of the summer months.
Yes.
So I know it's getting a little bit hotter here, so we'll see. We'll see what happens with the broader marketplace as the weather shifts. Maybe some of the market movement will remain its interchange, but we'll be here to follow the trends regardless.
Yep.
So, Steve, I think thanks for hopping on, and thanks for doing this. I know we're doing a little bit earlier in the week than we typically do the podcast, but there's great to be able to be in the office here and do it across from you.
Thank you for having me.
Yeah. And to everyone tuning in this week, thank you very much for tuning in, and we'll be back to talk with you again next week.